that. JPMorgan is out with a new call. The bank saying US stocks are at an increased risk now of a sell-off thanks to more hawkish Fed rhetoric and increasing equity volatility. Joining us now on the phone is the man behind that call, Dubravko Lakos. He's the head of US equity strategy at JPMorgan. Dubravko, thanks for joining us. Why now? The Fed has been hawkish since Janet Yellen gave that testimony on Capitol Hill, and it does seem like equities have been pretty fully valued, if not overvalued, for some time.
Yes, thanks. No, when you kind of look at the current backdrop, right, first of all, the market has rallied, a decent amount year to date. It's rallied, more than 10% since Trump election. And positioning generally, we do see it stretched, quite elevated, both across the fundamental hedge fund and the systematic, strategies. And volatility also has been quite suppressed, and we think that for a number of different reasons, volatility will likely also be increasing. So, in the midst of this backdrop, you're now also seeing all of a sudden a shift in rhetoric towards a more sort of hawkish Fed that's now basically, talking about a March hike. Mm-hmm. So I think when you basically put all of these different elements together, that could potentially increase the pressure on the market, and that's why we're basically saying that
pretty transparent.
Short term, you could see some form of sell-off.
Yeah,
Sorry?
It's all pretty transparent though, right, Dubravko? I mean, as soon as the Fed started speaking in a more hawkish tone, the market priced in a March hike, and it hasn't given way to any capitulation in any asset class. So when might you think this would start, or what would be the catalyst?
Well, if you look at the last two rate hikes also by the Fed, the market typically responded fine sort of in the week, 2 weeks running up into the FOMC decision. But typically then once the decision gets made, it's really the day after, the 2 days after, as sort of as things sort of settle in, that's when you sort of start to see some cracks and some pressure kicking in the market. So,
yes.
You could see a same thing happen right now. Plus, the Friday after the after this March FOMC meeting, you have a fairly large option expiry taking place, which could, again, potentially impact volatility levels, and that could pressurize the market.
If you take a look in my Bloomberg, you'll know this, Dubravko, but you'll be able to see WPE is the function that the Dow Jones is priced at around 19 times earnings, the S&P 21, almost 22 times earnings. What would that need to go back to for you to be comfortable with the valuation of these indices?
I mean, look, valuation is a very, very hard thing to look at, especially in the context of this cycle. Numbers are, valuation figures are inflated because we're in a structurally lower interest rate and yield environment. What we do see is temporarily, sort of short term, we do see some weakness that I think, could be ballpark 5%, so low to mid-single digit type, pullback. But I don't think the market sells off more than that. I think there's still, money sitting on the sideline that would basically take advantage of this weakness and then basically reposition. Right.
And Dubravko, where are you anticipating the S&P 500 will drop to, if that, and is that where we'll see the most movement?
So we have a price target of 2,400, which we're basically calling largely policy neutral, if you will. So now, there is clearly upside risk to that if the new administration is able to sort of get some of these pro-growth reforms through, the biggest ticket item being, corporate tax reform. So I think it's sort of we're in a wait-and-see mode before we decide to revise anything.